Most people never build real wealth because they were never taught how money is actually taxed. You've heard of saving, investing, and budgeting, but if you don't understand the 3 buckets of money, you're flying blind. You're running east looking for a sunset. I always say it. This isn't just theory. It's how the wealthy build and protect their legacy, and let's walk through it right now. Number 1, the taxable bucket. This is your checking, savings, and brokerage accounts. It's liquid and accessible. It's also fully exposed to taxes and litigation. You pay capital gains on investments, interest on savings, and even taxes on dividends, whether you use that money or not, phantom income, for example. Most people have the majority of their money sitting in savings, doing very little, while the bank lends it out, earns 6 to 8%, and gives you less than 1%. It's called fractional reserve lending. You should know this, folks. While they're making money off of your deposits, lending you for mortgages, car loans, personal loans, etc., you're here collecting pennies inside your couch and paying taxes on that money as well. It feels safe, and it's only a feeling, because this is where your money's most vulnerable, not only to erosion from inflation, but the confiscatory nature of the government vis-a-vis taxation. Number 2, the tax-deferred buckets. Think of 401ks, IRAs, SEP IRAs, annuities, pension plans. These accounts let you defer your taxes until later on in life. It probably sounds good at first until you realize they're just delaying your taxes, not avoiding them. You're deferring your taxes until you retire and exposing yourself to the risk of what you cannot control. Tax rates, for example, might be higher when you retire than they are today. So you have to be mindful of all that stuff when it's going on. You're also taking on future tax risk. The government can change the rules. They've done it over 40 times since the 1960s. You have no control over the tax bill down the road. And please beware of that when you do planning today. Plus, you lose flexibility. Withdrawals can't start until at least 59 and a half. They come with penalties if it's before that. And RMDs, after age 73, force you to take money whether you need it or not. So it's a shell game. It's a catch-22. Somewhere in the middle of that, I think in the end you may lose. Number 3, tax-free bucket. This is the bucket most people never hear about. Roth IRAs, properly structured whole life insurance, certain trusts, and municipal bonds. In this bucket, money grows tax-deferred and can often be accessed tax-free. It's also off the radar for income-based taxes and doesn't count against things like FAFSA or Social Security thresholds. Whole life insurance, yes, I know I talk about it a lot, is a powerful strategy when it's in the middle because it offers growth, liquidity, protection, legacy, all in one. Financial Swiss Army knife. It's especially handy when in 2025, single filers must have a modified adjustment gross income of less than $150,000, joint filers $236,000 in order to max fund their Roth. Why? The IRS knows how good that Roth actually is, so they limit what you can put into it. That's why wealthy families use this bucket to build intergenerational wealth while keeping the IRS out of the equation because, let's be honest, folks, they're not giving discounts at the IRS window. As you can see, folks, I'm flowing like G.I. Joeing, and let's talk about how the wealthy allocate these dollars. While most middle-class folks have 80 to 90% in taxable, tax-deferred buckets, the wealthy, they look to use leverage. One of the best leveraging tools that's been around for hundreds of years, and the banks love it, is cash value life insurance to move money into protected, growth-oriented environments. The wealthy, guess what? They're not reacting to taxes. They're planning around them decades in advance, or at least getting the right people in order, think of a fractional family office, to have those conversations versus worrying about a refund that comes halfway through the year just to repave the highways in the state that you live in. So if all of your money is sitting in one bucket, you're playing a dangerous game with taxes and inflation and liquidity. Go ahead, click the link in our bio to talk with someone from the Epic team. We're going to help you structure a strategy that protects your future, preserves your wealth. And here's the truth. Most agents won't show you this because they don't know how or they're not paid to. We believe in education first before a transaction. And if you found this helpful, don't forget to like, share, and subscribe. We break this stuff down every single week without fluff and with just enough Jersey to keep you interested.